Joining us exclusively today is Devon Energy CEO Rick Muncrief. Rick, it is great to have you back. Our thanks to you today.
Thanks, Carl. Good to be with you this morning.
We've been talking a lot about your cash return model and the time we're in. We just talked about the equity return, the margins, the cash flow, the dividend payout. How do you think about the time we're in right now, both for Devon and the industry at large?
Well, I'd say the time we're in right now, certainly a lot of volatility in markets. We could continue to return from the pandemic. Certainly, you have geopolitical tensions that we see. You're reporting on quite a bit around Ukraine and the Russia potential impact there. So there's a lot going on in the world. But for producers such as Devon, we've tried to be very focused and very disciplined and stick to our knitting. And quite honestly, it's working out very well. I'm really pleased with the performance last year. Carl, it's almost like winning the national championship one year. You can celebrate for a weekend, and it's time to get back in the weight room. So that's how we're looking at this year.
Yeah. How you talk? People are still amazed at the discipline regarding the model. You mentioned the Ukraine tensions. Right. We talk about the increase in consumption and demand all the time. Are there limits to that discipline? Is there a point at which you say maybe cash return does take a backseat to production?
Well, I don't see that taking place in the near term for sure. As we talked to investors yesterday, I got that question several times in several different forums. The reality is that if you look at the forward strip of what commodity price or crude oil prices are, it's very backwardated. In other words, near-term pricing is much higher than pricing 12, 24, 36 months out. And the shape of that curve is very, very impactful. And so what the curve is telling you is it does not think crude oil prices will stay at this level, forever. In other words, it'll be off $10, $15, $20 a barrel lower than what it is today. And that's just something you simply have to dial into your long-term planning. We're very active. We're one of the most active drillers and developers in the U.S. right now. And it's not like we're sitting around not reinvesting our business. But the cash flows are so much stronger than they've ever been. We mentioned on the call yesterday that we just finished up a quarter that's the best quarter that Devon's had in the entire 50-year history of the company. And so something to really think about. But we're only reinvesting about 30% of our cash flows back into the core business, if you will. And so what we're doing with that excess cash then is returning it to shareholders in the form of the fixed plus variable dividend, which is currently about 8%. And then we've also, announced a share repurchase program. Originally, authorization was $1 billion. We actually purchased $600 million just in the fourth quarter. Very attractive prices, and we've upped that authorization. So we have $1 billion. We'll continue to pay down debt, callable debt, when we can too.
Rick, it's Morgan. I mean, you just talked about that backwardated, crude chart. If we were to see an invasion by Russia, does that change the scenario? And if so, how are you gaming that out from a hedging standpoint?
Well, I think that once again, hedging, we're currently about 25% hedged into the future on oil prices. I think that once again, Morgan, you'd have to see that curve really come up in the back end of the curve, so to speak, for it to be attractive to us. I think most of our investors want exposure to a stronger commodity price, and so I think that we'll stay, kind of in that range. Is probably the prudent thing to do. If you did see, the reality is, even if you do see an invasion, we are fighting supply chain issues in the energy sector, just like every other sector is. And so getting truck drivers, getting supplies, getting people in the field. There was a report that I read the other day that in a Permian Basin, one producer in a Permian Basin, very active producer, over 60% of the people working in the field actually are coming in from outside of the basin. And so that's just something that you really have to think about as you think about forward plans. So you could spend a lot more money. I just don't know how much more efficient you would be. And that's what causes us to pause as far as the need to put a lot of additional capital to work.
Shepard Smith here. Thanks for watching CNBC on YouTube.